Okay, so today I thought I'd share a tool that I use all the time, which I find is reasonably useful and maybe of use to some of you. And this is looking at certain financial information over time, particularly shares outstanding, right? And particularly diluted shares outstanding. And here we're in a tool called TradingView, which some of you may know. This, I think, is available in all plans. I have kind of a base subscription plan, which I think is kind of well worth it. But information is available in a bunch of different ways. Every quarter, the nice people, I think at FactSet and other places, put the information into the database. And then recently you've been able to put that information on charts and be able to look at this information and derive a little bit of insight from it. So right here we have Apple. We have the stock price, obviously, and then in this particular view, I have diluted EPS, so this is just earnings per share. EBITDA, or earnings before interest and tax, depreciation and amortization. That is essentially a metric of the raw profitability of the business. You can debate the applicability of it, but for non-financial companies, so non-banks and other financial institutions, this is a reasonable benchmark for how much money a company makes. Total revenues, and then shares outstanding. So what you're seeing here is you're seeing a seasonal business. Seasonal insofar as you can see that the fourth quarter, the holiday quarter, seems to be the strongest every year. You can see the evolution, you see the peaks. You can start getting a sense of kind of how the business behaves. You can see that going into 2019, the business was a little flat, so even before COVID. And you can see the stock price reflecting it. Since 2015, which is where we are and start here, we have a business that was doing $75 billion for the fourth quarter that is going to about 123. So you're seeing healthy growth overall if you kind of look at it. But here, what I want to point out is the shares outstanding, right? So shares outstanding have gone from about 24 billion shares down to about 16 and a half. So in that period, in the last 7 years, you see two things. You see certainly the share count coming down, and then you see the smoothness of the curve, which is that this is a company that is steadily returning capital shareholders, which is debatable whether it's a good idea when the stock price is extremely high. But what you're looking for is a relationship of management to the shareholders, which is a mutually beneficial one. And what that means is you want to look out for companies that are raising money when the stock price is low, meaning that they did not really plan for bad times. We'll see that in a couple of examples during COVID. And you want to understand how much they are returning to shareholders, which itself is kind of a good thing to make sure that the company feels it's stable enough to be buying back its stock. What you really want them to do is to buy back its stock when it's starting to be low. That is something that is generally beneficial to shareholders, as they keep in mind that the share count, the shares outstanding, means the amount of shareholders that are sharing with you in the pie. So obviously, if there are less shareholders, that is a relatively good thing for you, or better thing. Obviously, everything can be done. A lot of companies bought a lot of shares very expensively and then ran out of capital when it came down to hard times. So it's not always a good thing. But what you want is you want to see flexibility. You want to see smoothness here, right? Let's also make sure that we understand that this is not a valuation point in any way. This is something which is only about looking at kind of the relationship the management has with its shareholders and how it husbands its capital. A company could be very highly valued, very lowly valued, and still behave completely differently when it comes to its shareholders. Let me give you another example. If you look at Applied Materials, which is a good company to look at for that. Again, not as smooth, but what you're saying is a company that's reduced its share count quite substantially, from 1.3 billion down to about 900 million shares, while the business itself, for example, on a quarterly basis was going from about $2.5 billion to about $6.5 billion, $6.2 billion in revenues, and then EBITDA kind of $500 million to about $2 billion. So this is a business that, again, has been growing substantially, and you can see that from the stock price. Clearly, the stock price represents that, but has been returning value to shareholders. And when you're looking for companies particularly these times, trying to understand where the valuation of high duration assets like technology stocks may have. This is the kind of stuff that can give you a sense of the professionalism or the level of comfort you can get with the management of a company or how it's generally behaving, completely separate from obviously the stock price and other metrics. Now let's look at another company to give you the opposite example. Let's look at Carnival. So Carnival going into, if you had looked at this chart going into COVID, right, forgetting the stock price, which was kind of all over the place, but you saw a business that was relatively profitable, consistently profitable in all quarters, seasonal, surprisingly. Relatively growing sales. So we're talking about in the 2014 to 2020 range, somewhere between $5 billion to $6.5 billion in growth, for that holiday quarter. And then a share count coming down, and again, most likely through share repurchases. But what you see in COVID is right at the time when things hit the fan. And in this particular case, clearly, and this is no criticism of Carnival, it's very, it's impossible to plan for a pandemic, and you can be over-prepared. But still here, the company essentially ran out of capital and needed to raise capital in order to be able to I don't know if to continue operation, but certainly to feel like they were in control of their business. So the share count went from about 684 to about 1.4 billion in size, which is quite substantial, 40%, 45% increase. And that means that many more people are sharing in the shareholder pie at a time where obviously revenues are nowhere close to what they were before. So this is kind of a difficult one because this tells you a lot in my mind in terms of the risk that's involved. This obviously could all work out well, but you can see that this is a company that goes out and raises capital when things, or in this particular case, when things went very bad for them. Another example, something like there's a mortgage REIT, Invesco Mortgage. So again, rising share count, this time steadily. At a time when their business got impaired. So this is, kind of a spiral a little bit, where you see the numbers, revenue numbers substantially hurt and then growing losses. Another example I was looking at recently is a company called Desktop Metal, which is more of a technology company. Interesting story. I was trying to figure out in my own mind whether this was the kind of company that could grow itself out of substantially through this difficult time. And what you see here is that you see, substantially rising share count, right? Forget COVID because I don't think the company is really related to COVID, but substantially rising share count over the last 5-6 quarters, rising sales, but then substantially larger losses every quarter. And so what you're seeing here is perhaps buying sales or otherwise finding sales through more aggressive marketing or marketing expenses or other things that make the sales go up, and this is being financed by more share issuances. And again, that's not this is the kind of stuff that you want to try to keep an eye for. There may be still a reason to invest, and certainly the stock price reflects the fact that it's gotten hurt. But this is something to keep in mind, and it tells you a lot about how the management team has been looking at its share ownership. Finally, we can look at Paramount, which is the old Viacom, and the point I want to make here is that sometimes share count just jump up because of mergers and corporate actions. So in this particular case, an acquisition was made, and you can see how the revenues, at least for went up quite substantially. Once the merger closed, and the results are a little bit mixed. Most recently, I think there are a few charges here, but basically the company grew, and so in that particular case, a growing share count is not necessarily bad. It all depends on how well the merger integration works and the long-term prospect of the firm. But in this particular case, what you saw before was certainly the effect of a slow share repurchase program That looks like it's halted a little bit. This doesn't really tell you much. It won't add a lot of, but you can add this tool to your checklist, and in some cases it can tell you some things. And particularly when you're looking in an environment, just a step back, when you're looking in an environment like this, which is quite volatile for companies whose underlying business are reasonably strong, and you can look, this is where it becomes interesting to look at things like Target. Target has, had substantial reduction in share price, share count from the 650 million shares to about 480 million shares over the last 6-7 years, growing sales. So you would hope that this is a company that has the flexibility to buy back substantial shares since its stock price dropped dramatically recently. Same thing for Walmart, and this is where it becomes interesting to try to figure out how these companies are going to react. Again, none of this is advice, but it's just another metric to look at, and I find this tool to be super helpful. There are plenty of other ways you can use the tool. We'll go over some. You can have views like this one where you put cash, total debt, and then what becomes also interesting for different reasons, funds from operations and from financing. This gets a little bit inside baseball, and we can go through it in detail another time, but this one metric of shares outstanding versus revenue and the stock price can tell you a lot. Hope this was helpful. Thanks.